So this week, I want to finally take you through the final draft of my revised plan. This started a little under 4 weeks ago, and I think because of the nature of some of the changes has taken longer than I usually do when I revise the plan. Instead of reading it to you word for word, I think it will add more value to give context to certain sections and why I've structured things a certain way, as opposed to what it is. Obviously, at any point, you can just pause the video and read in detail if you want that granular sort of detail that I'm not going to go into, but I will go through each page, and I hope that adds value to you and improves your process of drafting a plan. So from the content, you can see we start with the 4-step process, getting straight into it. Total is about eight pages. You don't have to have everything that I have. I think I just try to cover it quite comprehensively. This doesn't speak too much around execution and the detail on that, which is, I think, something I'll add over time, but it really just covers how I essentially make a trading decision and then the risk and trade management around that. And then obviously also just discussing my processes outside of just the analysis. How do I journal, the content that, is scheduled for this next period? Because I almost see this as a plan for the next 5 weeks or 30 trades before I then take a bird's eye view at the data and, refine and optimize. It says 4-step process. There's only 3 because the 4th step is execution, and that relates to risk and trade management, which is covered in the next section. Yes, I could just call it the 3-step process, but it's the 4-step process. Deal with it. All right, so outline the markets I trade, the sessions that I'll execute within. So I don't close at the end of a session, kind of just let a trade run throughout, and I let price develop in its own time. Looking into that, from a longer term perspective in terms of swaps and, some commission you end up paying from obviously rolling that over into the next day, whether, entries are potentially premature or not. That was a factor in the challenge when I just looked at the swap fees that I paid. It was higher than it should be. And then we dive into the high time frame framework. So what has been a massive change here is obviously incorporating PD arrays. I look at that from a weekly perspective. And that is just to frame where we're trading within that spectrum from, premium at our extreme highs, right to discount, which is the extreme lows, and then equilibrium. So I frame it on the weekly, and then the daily is really just used to measure then how price is completing or rather being delivered from premium to discount and vice versa through the various daily impulses and corrections, and then finding opportunities within that. So essentially then when you come down to how I then determine opportunities and potential trade setups, you'll see it's under 4 conditions. Either the daily structure is bullish and the market is trading higher at or from that internal range liquidity. So obviously once we pulled back, and that's essentially taking price from internal range liquidity to external range liquidity. Same for the bearish daily structure. Bearish leg prints, price retraces into internal range liquidity, and then we're taking it from that internal range liquidity to external range liquidity. The other set of opportunities that I look for from external range liquidity to internal range liquidity. So maybe I should have explained that first, but essentially then daily structures formed, and then there's certain things I look for to confirm that we're now correcting high or lower, depending on, whether it was a bearish or bullish leg, respectively. And so now I'm looking to take price from that external range liquidity to internal range liquidity. In theory, it should be easier to take price from internal to external range liquidity because you've got more confirmation of, that price will complete. Complete meaning that once you form structure, you correct, and then you expand to complete that structure and form new structure. And so taking price once it's corrected and then signaled that we're about to continue, there's technically more confirmation that we are now completing the move and expanding to those, extreme highs or lows or equal highs or lows. But from my data, I've actually found that the setups who have done really well have been from that external range liquidity to the internal range liquidity. And I think that has mainly been because from internal to external, there was a setup in my previous plan that almost called the top or bottom. So before price had established that structure high or lower, from that internal range liquidity, I would take trades that are calling those extreme highs or lows. I guess prematurely you could say, but before, a 4-hour trend has established. And I think that's a key difference in this section and probably why the other trades perform better, because when I'm looking at it from external to internal, I'm only considering trades in line with, that 4-hour range when the 4-hour and the 1-hour aligned. Previously, the 4-hour could still be correcting lower or higher, but then once the 1-hour shifts, then I can take a trade. And I think that's where, the difference in performance really came. Setups that had more confirmation, but I was maybe taking prematurely. So the timeframes I use in this are the weekly, daily, and 4-hour. The weekly, obviously, to plot my PD arrays and then determine the long-term bias, the daily for the structure, and then the 4-hour for that intraday trend. So that kind of frames my high time frame framework, and it establishes, am I taking price from internal to external or external to internal? Once I've determined that, I then move on to my trade parameters, which use the 4 and the 1-hour to kind of determine the intraday range, and then knowing that price needs to be aligned or in line with that intraday range for me to identify a trade opportunity. So yeah, really, I've cut it down to 2 setups. We've got that internal to external and that external to internal. And that kind of just frames, what I'm looking for and what differentiates a high and a low risk position in those 2 scenarios. Once I've determined that, I then look at where price is trading within that intraday range and looking for and price must be at least a 50% equilibrium in terms of that intraday correction for me to then take a trade. The low and the high risk is kind of used determining the depth of correction. And I found from my data that, the shallower the correction, the lower the probability of, that trade playing out. The third step is then entry confirmation. I have 2 entry types. One is, risk entry, aggressive entry, off a 15-minute candle after a time-based liquidity sweep and micro time frame confirmation. And then the second is a reduced risk entry, which needs a bit more. It's an extra layer of confirmation. We wait for that displacement, usually for the fair value gap to form, but I'm trying to incorporate more order block type entries because those are really powerful when they do form. I think I haven't primed myself to be aware of them and, then take advantage of them. So I think there's a lot of entries I sometimes miss and more refined entries where I'm not taking advantage of those order block limit orders. And then, yeah, kept it the same. This section hasn't changed, especially with the minimum 2-hour multiple, and then can't take a trade within 15 minutes of high impact news just to avoid that volatility risk. I'm looking at incorporating something around NFP days, interest rate days, because the market is usually very corrective building up to that, and we normally get the decision post that announcement. And so it hasn't affected me to that point yet where it's something I think would benefit my plan. But if I see that it's having an impact on, my results, or I'm taking a lot of losses around those news announcements, then I'll definitely look at incorporating something that speaks to that in the plan. Step four then looks at risk and trade management. So starting balance, per I keep my risk per trade at 0.5%, slightly conservative. Just once I've built a bit of a buffer, once I'm 2% up, then I can, gear up to full 1% risk, and then that I will take to the next payout. For the purpose of just getting into the swing of processing payouts when I am in profit and, extracting money from the market, if I can process a payout on a payout day, then I will. I think over time, I may look at only processing a payout once a month just to allow some sort of compounding to happen, because 2 weeks, the way I trade, isn't really a good representation of performance. And so it can be limiting to prematurely process that payout if you are, 3.5% up, because taking it back to, $100 mentally, you feeling like you back at zero, as opposed to being able to build on top of that 3.5%. And, by the end of the 4 week period, then potentially be up 7.5, 8%, even plus. And so especially for me, who uses a reduced risk, at that starting balance, it wouldn't allow me to take advantage of that full 1% as much as possible over a full 4 week period if I'm only capping it to, 2 weeks, where in that first 2 weeks, that could be me just breaking above 2%. And then, I kind of reset it. So I am thinking about that in the long run, but I'm also aware that, initially early on, I need to get my mind primed for, just processing payouts and, what does that feel like? What are the mechanics around that? Let me build a little buffer too. Let me enjoy, some of the profit that I'm able to generate. And then, yeah, I think 5 to 8 weeks is enough time before I can then start delaying that a bit and just playing around with longer durations, just to allow the account to, yeah, do its thing. That may change. Look, if I'm able to uh, start another evaluation in that time, but I doubt it. That's extremely optimistic, because obviously then over time, the more capital you get, say if I'm trading $300,000 or $500,000, 3 to 4% in 2 weeks will be what you can do, in 4 to 8 weeks on a 100K account. So it may become relative that way, kind of just play it by ear. But I'm sure there are patterns or advantages or benefits or, limiting factors to either delaying that payout or, you know, just taking it whenever it comes. But we'll see with time. So that kind of just explains that. Processes and intentions. My goal for this plan over this next phase, 5 weeks, just to achieve a margin of error of 10% in executing the plan. There will be a few trades that don't meet the plan. I want to limit that as far as possible so that the data is as accurate as it can be. I want to process at least one withdrawal before the end of the second quarter. We've got 3 weeks in this month and a full month till the end of the second quarter. I don't think that's unrealistic at all, given that, payout dates are every 2 weeks. So I just need to have a profitable week, to be honest. That's what that says. But I think it's just the action of processing withdrawal. And so, yeah, let's see how we do with that. And then differentiating between low or high quality and low and high risk setups. That's something I've been thinking a bit about. They may be the same thing, but I want to figure that out over this time. I'll come back to this gray part. And then these are just my processes of a consistently profitable trader. The content that I'll be consuming over this period, I'm obviously on now month 6 and 7 of the ICT 2017 mentorship. And then just, lectures that I watch when I do that, my forecasting, obviously that's a daily. ASR, strat development, building the modern day trader. The goal has not changed, but yeah, just mindful of the detail and the routines. This little gray thing is almost just like a note that I do to myself. And yeah, basically, you are officially a six-figure funded trader. You deserve this. Your consistency has filtered down to the bottom line and will continue to do so if you remain disciplined in your approach to your processes each day, week, and month. Passing evaluations, however, is not the final goal. This was a stepping stone to unlocking the next challenge. There's more work to be done. The job is not finished. And with that, remember, guys, that consistency is the choice you make when you start doing the things you know you should be doing day in and day out.